Hi, class. This is my last lecture while I have been isolated, I guess, for the coronavirus. And so I'm, I'm elated that my work is done, but I know your work is just getting started. Uh, Got to be pretty painful to listen to all these lectures. I get that. And sitting from home, much, much prefer to have you in my class, even if you were sleeping or playing on your phones right now. I really miss everybody. And this thing is hopefully going to come to an end soon, especially I hope before the fall, so that I will be back in the fall. And for all my students, I hope you'll drop by into my office and say hello. You're always welcome. Uh, and especially those who are interested in accounting as a career. I love having those conversations. I can share a lot of stories about my career. I loved it, and that's why I'm here at the University of North Texas to give back to future accountants, and hopefully you will operate and have as much fun in accounting as I had. So anyway, it's great to be with you here in my home, I guess, at least. And I know my work is really pretty much done at the end of this lecture, but your work is just beginning because it's a lot of material, I know, to understand and learn. So in the cash flow statement, this is kind of the culmination of everything that you've learned throughout the semester. And doing a cash flow statement, you definitely have to understand the income statement, the entire balance sheet. But before we get started, I want to take a step back and have you think about what is the purpose of these financial statements. And so I've said all along, accounting is a measurement system. You know, we use debits and credits to measure, and it's a reporting system. And so we're going to report on in the income statement, how did the company perform? Did the company make money? Were they buying stuff low at low cost and selling at high prices? You hope they are. Are they hiring great employees if they're a service company and able to command higher price for the services they're offering? That's all in the income statement. And the balance sheet is a point in time. What are all the assets that the company owns? What type of assets? How much? What are the cost of those assets that are sitting there that the company owns at any point in time? Then also, what are the claims against those assets, the liabilities that the company owes, and the equity, the leftover piece that owners have, paid in capital, don't forget that, and retained earnings. Now, the third statement and the final statement that we're going to talk about for this course is the cash flow statement. So this statement, to me, even more than the others, tells the real story of the company. What are they doing with their cash? Where are they receiving cash? From customers, hopefully a lot of cash from customers. And then where are they paying cash out? And we get into even deeper. What are they using that cash for to invest in the future? What's the sources of that cash? So in here, you can tell a lot. You can get a lot of information, the full storyline of the company out of the cash flow statement. You still need to read the income statement. You still need to know they're making money. You still need to understand the status of the balance sheet. What kind of debts do they have? What's the financial status of the company? But the cash flow is integral with all of those in telling the full story of the company. Probably more than any other statement, the cash flow statement can do a much better job of helping you predict the future of the company. And so with that, I'm going to share my screen. I think you've heard me many times say I do not invest in any companies without reading the financial statements. And I'm going to just let you know, hey, personally, the cash flow statement is as important as any of those. So we're going to be doing a cash flow statement here in a minute, so just ignore that stuff to the left here. So if we look at the cash flow statement, it takes all the ins and outs of the cash account, really, if you want to say it there. That's why you're going to know a lot about all the journal entries to do a cash flow statement. And we're going to take all the cash received and all the cash paid, every transaction, we're going to add them all up, and we're going to put them into three buckets. Cash flow from operations, cash flow from investing. And now when I say, I'll talk about that in a minute. Okay, cash flow from financing. Now, a lot of times what you'll see in cash flow statements, and maybe this one we're going to do, I say from, it could be, a lot of times you'll see provided by or used by. In other words, which cash is provided by operations? How much cash are we, from operating the company, how much cash are we, how much is cash increasing? How much are operations providing more cash to the company? Or maybe it's negative cash flow from operations, that the operations are using cash. So that would be a negative. And that provided by or used by could be in the same from all of these. So let's just talk high level here. Cash flows from operations. These are the cash that we are receiving or using from operating our business every day, buying and selling inventory. So this is important. You want this to be a big positive number, right? You want to see a big source of cash. Cash flow from operations is almost as important as net income. In fact, bonuses, executive bonuses, and for all salary employees, we're on a bonus plan based on how well the company did. 60% of that bonus was based on net income from the income statement, 40% based on cash flow from operations, because that is very important for shareholders. And then cash flow from investing, this is about long-term assets. How much money is the company spending to purchase long-term assets, or maybe selling long-term assets? And so, by the way, here's one. You want it to be a negative number. You want to invest, you want to see companies that are investing in their future, buying a lot of factories, expanding overseas, expanding their factories, producing more inventory, or buying more retail locations so they can make more money. Maybe you're looking at a company that operates only in one city, and you can see from the cash flow statement, oh, wow, they're investing in other locations outside of the city, maybe in the whole state. Guess what? If they're successful in the whole state, maybe in the next year's financial statement, you'll see, hey, they're expanding out beyond one state to the region, maybe to the whole nation, and then ultimately maybe global. And so here you want to see a big negative number. If a company is making very high net income, generating a lot of cash flow from operations, but they're not investing in their future, that might be a pause for concern. Is this company just milking what they have? Maybe that's not a company who will have sustainable growth in the longer term. Even the plants they own may be starting to deteriorate. So if you need to do maintenance on significant improvements to your operations and your long-term assets, that will be in investing as well. Remember, anything that is capitalized, back to our property, plant, and equipment chapter, if it's capitalized, we're going to debit the asset. It's going to be a long-term asset. So any change in long-term assets go into the investing. And finally, financing. What this is about, long-term debt or equity. So where is the company receiving money from outside of the corporation? Are they borrowing money? Maybe they're paying back debt. And so that could be a negative cash. A plus in cash here means long-term debt has grown, they're borrowing money. But it also could be if long-term debt is declining, they're paying cash out and reducing debt. And then finally, have they issued shares, or maybe they're buying back shares, but that could be a negative to cash flow. So these three areas tell a lot. By the way, payment of dividends, which we covered in the last chapter, that is going to be in the financing cash flows. So let's go look. What I've done here, and let's see if I can find this now while I've got you with me here. Let's go look at Starbucks. I thought we look at actual cash flow statement. There's nothing like looking at an actual cash flow statement. By the way, I will show you how to get to the financial statements for any company. Usually you just go to their website. This is the main Starbucks website. You can see they're talking about their issue with coronavirus and Uber Eats and all that. But you come down here, About Us, and you see Investor Relations. So this is about their investors. And we can look at, here's their Q1 fiscal results. That's pretty interesting. What I was going to go to is look at investor relations. When I wanted to do, oh, here you go. Press releases, events, financial data. So almost every company will have this on their website. So let's look at a full year. This is back to the accounting period, right? Because you could look at a quarter. That would be January, February, March, or April, May, June. But I'm going to look at an annual report. Let's look at 2019. Here's the 2019 annual report. And here you go. Oh, it looks, there's a big, that must be in Seattle or somewhere. I don't know where that is. Oh, Costa Rica. So yeah, not Seattle. They don't, I guess they don't have mountains in Seattle. Never been there, but here, this is where the coffee beans are grown, right? That's a picture of the annual report. It's a little bit of advertising there. And this is something, this is Form 10K. This is filed with the Securities and Exchange Commission. This is what I used to do. I did for 15 years. I was a chief accounting officer, and I created these Form 10Ks for both Maytag, where I worked as chief accounting officer for 4 years, and then later for Lennox for 11 years. And so here you go. There's a lot of stuff you can look at in a 10K, and very interesting. What's the risk of owning this? There's a lot of stuff here. I could do a whole semester-long class on a 10K, but I'm not going to do it here. Here's the financial statements. They are on page 44. So let's get to page 44. Here's a lot of stuff in here. What page are we on now? 21. Got to keep going. 42. 38, got to keep going. Here we go, financial statements. By the way, let's see what else I got here. There you go, consolidated statement of earnings. So this is the income statement. That's another name for the income statement. Look at this, and these are in millions. So they had $21.5 billion in revenues from company-owned stores and like. So here's their total revenues right here. Hopefully you can see this. 26.5, that's billion dollars. And look, they were only at 22.3 billion back in 17. How much is their net income? We'll come down here to the very bottom. 2.9 billion to 4.5 billion. They're slightly down this year, 3.6 billion. And guess what? Earnings per share right there. They made $2.92 diluted earnings per share. We'll get into that with you. And here's our statement of comprehensive income. That's beyond the scope of this course. Here's our assets, liabilities, and equity. So you can see they have $19.2 billion in assets, and their liability and equity, $19.2 billion. But here we go, statement of cash flows. Now, I didn't even really look at this before class, so I don't know exactly what the storyline is going to be here. I start off right off the bat. 5.1 billion cash provided by operations. Well, that seems really good. Boy, 5 billion, that's a lot of money. That's a lot of cash generated from operations. But look, last year they generated almost 12 billion in operations and 4.2 billion before that. Investing activities, they've invested $1.1 billion. Look at that, $1.8 billion additions to property, plant, and equipment. So they invested $1.5 billion in new stores. That's what this is. 2 years ago, almost $2 billion last year, and $1.8 billion this year. Where are those stores going? Because every corner has a friggin' Starbucks. Right now, I miss Starbucks because they're all closed. Oh my God, I would love to have a Starbucks coffee right now. I'm just not willing to go through the drive-through at this point in time. But you know, where are they building these stores? Guess what? Internationally, they are growing in China and around the world. So that tells me something. There's a story there about this. And so they've also divested, means they've sold certain operations. That may be just good discipline. And then where's their money? Where's the financing? Okay, they issued here proceeds from issuing long-term debt. Almost 2 billion. They issued more debt. 5.5 billion they issued last year, new debt. So they're receiving cash. They were borrowing money. Why? To build new stores. But there's something else they're doing with their money. Look at this, back to the equity section. Here's treasury stock. They're repurchasing their own shares. A lot of companies are doing this. This is big dollars. 10.2 billion this year, in 2019 last year, and 7.1 billion 2 years ago. So you can see a lot about this company. They're very serious about repurchasing their shares, but guess what? They're still investing in the company. Now, something I care about is dividends, and here's the cash dividends paid. 1.45 billion 2 years ago, 1.7 billion, 1.7 billion. I love cash dividends. Now, companies don't have to pay cash dividends, but guess what? I'd say, here's the storyline. They're generating lots of cash from operations, 5 billion. That's plenty of money to pay those dividends. And I'm sure if you're in class, you'd be kind of like looking at me askance right now, shaking your head because, hey, all the stores are closed right now. So they're, if we looked at the 2020 cash flow statement, it's not going to say 5.1 billion. It's going to say, it may be negative. It may be that crazy with all the stores closed. They're still paying rents. They're probably still even paying some of their employees, maybe benefits to some of their employees. And they're not receiving cash from their customers, not very much. And so guess what? They may not be paying dividends. So I'd be a little reluctant now to be buying their, and by the way, they have $2.7 billion of cash on hand. That's not enough to, cover everything. So if you wanted to invest in Starbucks because of the dividend, probably not a good idea. So that's a cash flow statement. Again, operating, investing, financing. Probably nothing better than just seeing that right there on screen like that. So let's get back. The last thing I'm going to do here, I'm going to go do a cash flow statement. Now, one thing before I get started here, let's talk about cash flow statement. Cash flow from operations. There's two ways to do it. Same answer on both ways. Let's start there. It's the same answer. Whatever that answer is, it's the same answer. One is the indirect method, and the other one is the direct method. By the way, the FASB that sets the accounting rules, they want everyone to use the direct method. I have heard so many speeches by the chairman of the Securities and Exchange Commission and a lot of the FASB speakers who come to various conferences I've attended. They say, hey, we want you to do the direct method. Guess what? Rebellion. Almost all companies use the indirect method. Why? It's easier. And we're going to go do an indirect method cash flow here in a minute. You'll see how easy it is. It's a lot easier. With the indirect method, we start with net income first, or a loss. It could be a loss. So we start with net income right from the income statement, and we add or subtract non-cash items. Remember, when we debit depreciation expense, what do we credit? Accumulated depreciation. There's no cash, but we're reducing the net income, so we add that back, and we'll see that as we work an example. And then we do plus or minus changes in current liabilities and current assets. Why do we plus or minus these changes? because they're operating, accounts payable, inventory, accounts receivable. Those are operating items on the balance sheet. So we add or subtract there, and guess what? You get to the same answer. And I could prove to you that why we get the same answer, but I'm not going to bore you with that right now. I think you could look at the textbook. By the way, if you do the direct method, the FASB still requires you to come back and do the indirect method, so you prove out that the direct method was accurate. And so that's probably another reason almost everyone does an indirect method. So as you're studying the textbook, and I hope that you're doing that, I am not going to hold you accountable to the direct method because almost nobody does it. We are going to learn and do the indirect method. So how do we do a cash flow statement? All right, and now there's a lot of stuff in the textbook, and you can get to those great lectures from Pearson that you are listening to. But here's my kind of simplified kind of cheat sheet, if you will. And I could take any income statement and balance sheet, and I can pretty much create a cash flow statement. And I used to do those at Linux. They're a lot of work when you have I think Linux, we operate all over the world. I think we had 25 different foreign currencies we had to deal with. Obviously way beyond the scope of this course, and you won't have to worry about that. So, here we go, is any increase. And so I look at two balance sheets, last year's balance sheet, and if I come over here to, if you see the cursor here, I got the 2015 balance sheet and the 2016 balance sheet. So any increase, like here, receivables went down, so that's a decrease, an asset decrease. Anytime an asset decreases, that's a positive cash flow. Any increase in an asset is a negative cash flow. That should make sense to you, because if I buy inventory, what did I do? I debited inventory and I credited cash, right? So an increase in inventory means I paid more cash. That's a negative on the cash flow statement. A decrease in inventory went down means I was able to go sell that and collect cash. So that's a positive cash flow. So this is just rules to memorize here. Liability, so they work in the opposite direction. Guess what? Liabilities and equity, they work in the same direction. So if a liability increases, then it's a positive cash flow. What's a good example of that? And again, keep in mind, in the indirect method, we start with net income. So we may record salary expense, debit salary expense, which does what? Reduces net income. So that net income we start with has salary expense that's reduced that net income. But what if we didn't pay those employees? Salaries payable goes up. So salaries payable, an increase in a payable results in a positive cash flow. Opposite, if a liability decreases, it's a negative cash flow. So if salaries payable comes down, hey, it means I paid those employees. Credit cash, debit salaries payable. A debit reduces salaries payable. So assets work in the opposite direction. Liabilities and equity work in the same direction on the cash flow statement. Then, how do I get it into the right buckets? Changes in our operating assets, which are generally, there are some exceptions, but you will not be tested on, but all changes in current assets and current liabilities affect cash flow from operating. All changes in long-term assets affect cash flow from investing. And then changes in long-term liabilities and equity affect cash flow from financing. So this is the mechanics of how to do this. So let's go work a cash flow statement. And boy, if I had you in class, I would be passing out all these templates to you so that you can work this. And so there we go. All right. So you can see the cursor here. I'm going to take my income statement. Here's a balance sheet. I'm sorry, right here from last year. You see my cursor moving around there. And this company has $440,000 in total assets and $440,000 of liabilities and equity. You can see all the different balances there. and the company had total revenue and gains. They sold some stuff and they had some interest revenue. Total gains of 407 million, total expenses of 382 million, or net income of 25. That's 407 minus 382, 25. Now, there's some other things happening in these balances that we'll have to break out and understand. But let's go do a cash flow statement. Right here, right in Principles of Accounting, you can do a cash flow statement. By the way, you could pause the video right now and try to do this. And that would be great. And you can come back to it maybe after I work it, try it again. I am going to post 2 more cash flow lectures, the same ones I use for my intermediate class. They're exactly same type of problems I would have worked in class for you guys if I was there. I use the same examples both for principles and for intermediate accounting. The difference is you guys get multiple choice questions. My intermediate students, they have to go do a cash flow statement. And by the way, do not give them a template on the exam. And I give them a lot more curves on doing that than I give you. But in class, I work the same examples for both. So there's 2 more lectures. I'll give you the links to those on campus, just like this one here. So net income is a starting point for the indirect method. How much was net income? Hey, 25,000. So, and it was a plus 25. They didn't lose money, plus 25. And now I'm going to go and add or subtract all the non-cash expenses. Well, let's go look at that income statement. Oh, depreciation expense. There was a reduction in expense of 15,000 that we did minus 15 that made net income 20. If we didn't have that 15, net income would have been 40. But we had it. It was a minus. Guess what? It was non-cash. Debit depreciation expense, credit, not cash, accumulated depreciation. So guess what? Since I subtracted that 15 to get to 25, I'm going to add it back. Plus 15. Let's see what else. Oh, look at this. Gain on the sale of a long-term asset. Well, that's not supposed to be in operating. That's got to be in investing. So that's a plus. I got to subtract that, because that's basically it's still going to be cash. We'll see how that's cash. That gain is related to cash, but it's not for operation. So I got to subtract it out of my net income. And now I'm just in my almost brain dead work of going through my changes in my current assets and current liabilities. Remember, I've got 3 assets, current assets. They work in the opposite direction. So accounts receivable, it went, you can see my cursor over here on the left side of your screen, went from 80 down to 50. Minus 30, all opposite direction, plus 30. I must have collected. Accounts receivable went down. That means I was debiting cash more than I was crediting accounts receivable. And so those debits to cash as accounts receivable went down were positives. Inventory also went down. So I sold some inventory. So that's the opposite direction, plus 25. And my prepaid expenses, oh, that went up. So I debited prepaid expense, credit cash this year, and that's worth 10,000. That's an increase in prepaid, opposite direction, minus 10. All right, now we're down here to my current liabilities. Here, I've highlighted those. Accounts payable went down by 10. It went from 40 to 30, same direction, minus 10. Salaries and wages payable went down by 5, same direction, minus 5. And accrued liabilities went down by 25. So this is all minus 25. So I was paying off a lot of these liabilities and reducing them with payments of cash. Now I add all these things up and I get to plus 40. So this company had $40,000 in cash provided by operating activities. So their operating activities are doing good things for them on the cash front and generating $40,000 in cash. Look, their net income was only $25,000 and they ended up generating $40,000 in cash. So that's I know it's a fake company, but I got to be a business person here, and it's generating $40,000 in cash. All right, acquisition. Now we're going to look at the changes in long-term assets. We have 2 long-term assets here. notes receivable, and property, plant, and equipment. Well, let's start with property, plant, and equipment. It went up by 75. So I'm going to say that's going to be a minus 75 somewhere, but there's more stuff going in there. It went up by 115,000 from acquiring assets. It went down by 25 from assets we sold, and also went down by depreciation. Well, we've already taken care of that depreciation in the opposite direction in the plus 15 here. Okay, let's do, this is the easy one. Plus 115, we acquired assets, opposite direction, minus 115. And that makes sense, right? Credit cash, 115,000, debit buildings or whatever we bought there in the long-term assets. Now, here's a little harder one here. Net book value sold. I'm going to move this over a little bit. I think I've got some room here, even more than I would have in the classroom. So we sold property, plant, and equipment, and the net book value was minus 15. How much cash did we receive though? How are we going to know that? Did we receive 15,000 in cash? No. You know how I know that? Hey, there was a gain. We had property, plant, and equipment on our books, and we ended up with a gain that's on the income statement. How do we get a gain? We receive more cash. So we received $20,000 in cash, and the net book value of property, plant, and equipment was only 15. If you looked at the journal entry, it would have read debit cash, 20,000, credit property, plant, and equipment, 15,000, and credit gain, 5,000. Gain went to the income statement, which we see on our income statement. Gain on sale of plant assets, 5,000, and property, plant, and equipment went down by 15. So, and we received cash. So what do we care about in the cash flow statement? Cash. And so how much cash did we receive? 20,000. So therefore, plus 20. And that came from the minus 15 and the gain that was up here. All right. I mean, another way to look at it would be, hey, I had minus 15 in net book value. That becomes a plus 15. Then I've got to move this out down here, minus 5 plus 5. I mean, there's different ways you could think about it mathematically. I'd rather you think about it right here. We sold $15,000 of net book value. We had a gain. How much, therefore, how much cash we received. By the way, if we had a loss, $5,000 loss, that would mean we only we received less than a net book value, 10,000. So, you can back into that. Spend time, you're gonna have to know this. Spend time on the logic on this, one of the harder ones, I'm sure. Okay, and then we have another one, a note receivable is our last one. We've taken care of property, plant, and equipment. A long-term note receivable went up by 25,000. Therefore, we loaned another company or someone, a person, whatever, $25,000, and we debited notes receivable for 25,000, credited cash. So this is a use of cash. And negative. By the way, use the math. Plus 25 long-term asset, minus 25. Now let's add these together. Minus 115. Oh, you know what? I'm sorry. I have an error here. I'm going to have to go back. I just saw this right now. That's the trouble with recording this, because I do not want to go back and record the first 30 minutes of this lecture. I just noticed here we have a $25,000 net book value sold. I was looking at the 15. So we sold net book value 25,000, and the gain was 5,000. So how much cash received? It was 30,000. Sorry, and again, I'm looking at this line item right here. Last note value sold was 25,000, And so the cash received was 30. It's a good thing I have a little cheat sheet over here to look at my work, because I would not want to go back, start this whole video over and return it. So plus 25 in net book value, plus the 5 from here. So now, sorry about that, guys. Again, I picked up 15. I should have picked up 25. When you pick up 25, now the cash received is 5,000 more than the net book value to get to that gain, 30,000. So that should be a plus 30. All right, minus 115, plus 30, minus 25. I've got minus 110. How do I, if I was looking at this company's financial statements, how do I feel about that? Hey, I feel pretty good. The company's generating cash and they're investing in the future, 115,000. But wow, where did that 115 come from to buy all those assets? Because they only generated 40. Well, they sold an asset, they got 30 from that. That's helping, but it's even still 40 plus 30, 70. They're still short. Where did that money come from? All right. Where are we going to find out? In the financing section. What's the source of their money? And so here we go. Let's go look first at long-term debt. Well, long-term debt went down. So they weren't borrowing money. Long-term debt went down by 65,000. And so again, liabilities and equity, keep in mind, work in the same direction. So that's going to be a minus 65. Here's the one little curve I'll have to flow at you. We started with 140. Here's that 140. And we went down to 75. We did two different things. We issued some new debt for 25,000 and we paid off some old debt of 90. The rules require you to break out all payment of debt, old debt off separately from issuing new debt. So the investor has, by the way, more information. So the new debt plus 25 is going to be an issuance of debt, same direction. So we issued $25,000 of new debt, probably bonds payable, remember that fund chapter. And then we also paid off old debt, same direction, minus 90. Now, plus 25 minus 90, guess what that equals? That equals the change of 65. So we had a minus 65 right here. Here's that minus 65, plus 20, minus 90. That minus 65, same direction, shows up, but it shows up in two pieces. And that's why I had to do a long-term debt roll forward as part of the fact pattern. All right, now let's look at equity. We're rolling this thing home. Oh, here's where they get their money. $125,000 increase in the common stock account. So they issued new shares of common stock, same direction, plus 125. So that's where they're getting their money to buy that, to pay down debt, number one, and also to buy those assets. So they issued new shares. Now, the old shareholders might want to be concerned because now they own a smaller percent of the company because there's new owners, the tune of $125,000 of new common stock. And then finally, what happened to the last piece, retained earnings, went up by 10. It's got to be the same direction, but here's our retained earnings roll forward. You guys should know this by now. Beginning about 100 plus 25 of net income. We've already taken care of that over here, the 25 in net income, but we haven't taken care of this dividend piece, minus 15. That was a reduction in retained earnings. Remember, right from the very last chapter, you're going to be tested on debit retained earnings, credit dividend payable, and then debit dividend payable, credit cash. So this will be a payment of dividends minus 15. We add all this down, plus 25, plus 125, minus 90, minus 115. We've got a plus 45. So generated $40,000 in cash flow from operations. We invested $110,000 in the future of the company, hopefully, and we There's a lot of stuff going on here in this financing section. We paid off some old debt, but we issued new stock, but plus 45. Now, the next thing we do is, what was the net increase or decrease in cash? Plus 40 minus 110 plus 45, that's minus 25. We want to make sure we got it right. What was cash December 15? 75. What was cash at 16? 50. And we see this, I'm going to highlight this over here on the balance sheet. So we see that cash went down by 25,000. Now, if you did not have the cash flow statement, all you would have is be these statements here. You got the company made 25,000 and the cash went down by 25. Okay. Wow. Cash went down by 25. That tell you much of a story? Not really. But if you see that minus 25 was a plus 40,000 in cash from operations, minus $110,000 for investing, plus 45 from financing, and you got a lot more information here. Now, this financial statement, the three financial statements, the balance sheet, the income statement, and the cash flow statement tell a real story of the company here. And so with that, my friends, that is the end of Principles of Accounting. There's two more examples that I've worked out there that I did for intermediate. You're gonna have access to those. And on Canvas, there are 5 cash flow problems that you can go. They're in Excel spreadsheets on Canvas. You can download the Excel spreadsheets and you can work these, all of these on your own. And accounting takes practice. You work these, you internalize this, you are going to ace this next exam. And I want you, and pulling for you, praying for you to do well, finish the course strong. Again, I'm honored to have been your professor in this coronavirus crisis. This is crazy. And again, I certainly hope you're all healthy and safe. And please come see me in the fall. Hopefully we can shake hands by then, and it will be great to see your faces again. And I hope many of you are doing really well in this course. Will consider accounting as a major. Come by and talk to me about that too. Thank you, guys.